Let's talk some bad logic here in terms of specifically when a stock market starts to crash or any sort of financial market starts to crash, prices start coming down, then you're going to have people that show up saying, hey, buy the dip, prices are coming down, buy the dip. Hey, you know what? I'm buying the dip for this reason. And if the reason is what I'm about to talk about here, that is very, very bad logic. Now, to be fair, it is logical, but that's what makes trading and investing so difficult is because in many situations, things that are logical aren't actually good logic. It's bad logic because you need to understand how the mechanisms of the market work. And to offer up a little spoiler and to show you why it's bad logic, this sort of logic can lead you to a situation where the company is still around. So it's not like the company has gone bankrupt. A company is still around, yet your investment disappears. And I don't mean that metaphorically. I mean it literally. A company can still be around. They have not gone bankrupt, but your investment disappears. So that's what you got to be aware of. I'm going to explain how that's possible and why certain logic is just not good enough. I get it on the surface. It seems logical, but it's actually bad logic. So let's hop into it. Now, I should reiterate, I'm not saying any of this in judgment. I thought the same way. And before I understood how this mechanism in the market works, I had no idea. If you were to told me an investment can disappear, yet the company has not gone bankrupt, I would say, what are you, a troll? What are you talking about? That doesn't make any sense. But it is totally possible. So again, this logic here I'm about to talk about, I had the same logic. So I don't say this talking down to you. I say it from a place of, hey, I know how you feel. I've been there, but let me help you out and let me make sure that you understand all angles. And like I see this all the time. So I've just picked a couple different examples from YouTube videos that I've done. But here Anthony says, you know what? It's not going bankrupt. So a company is not going bankrupt. Is in his mind, hey, you know what? They're not going to go bankrupt. And you know the stock's at a good price, and the stock is not going anywhere. So that just reiterates the idea that hey, you know the stock's not going anywhere. In other words, the company's not going to go bankrupt. The company is going to stay around. Before I get to this comment, I'm not trying to imply anything. I'm not trying to say anything. It just happens to be about a certain stock that I'm going to talk about. And again, I'm not saying that that's what's going to happen here. I'm just using it as an example because it, again, shows the logic that I'm talking about of, hey, the stock's not going anywhere because the company's not going anywhere. And to take that a little bit further, you know, this person is talking about, you know, there has to be real value in a stock, right? So of course, yeah, again, logical. Yeah, there's got to be value in a stock. You're absolutely right. There needs to be value. But what sort of value? Well, this person, this person's definition of value is, as such, is found in AMC theaters. Okay, well, why would this person say that AMC theaters has value? Because he's saying the stock needs to have value. Fair enough, I agree. Okay, so, but what stock? Okay, what company? Okay, AMC theaters. Okay, but what actually is that value? Movies are a great source of entertainment. People are not going to stop making movies. So that is why it's valuable. That's why AMC, you know, their stock, the current price, this person is saying is value. It's not going to go anywhere because it's valuable. Why is it valuable? Because they host movies. Movies are not going to stop being made. People are not going to stop wanting to watch movies. You know, they're a great source of entertainment. And I agree with all of that. Movies aren't going anywhere. I don't think movie theaters are going anywhere. People are not going to stop making movies. I love movies. I love to be entertained. So right now, on the surface, this all seems to be logical, but it's bad logic. And let me explain why. The reason it is bad is because something known as a reverse split. I'm going to do a very Cliff Notes version in this video, but if you're interested in learning more about how it all works, then I'll put a link down to this video before, but I have a video, dedicated to just the topic of a reverse split. But this is why the logic we're talking about right now, hey, the company's going to be around. Hey, it's valuable for some sort of reason. And for this reason, the stock's going to be around. The company's going to be around. But the reverse split is what throws a massive monkey wrench into that logic. So again, want to learn more about reverse splits, in more detail, just go and watch this video. And like I said, I'll put the link down below if you're watching on YouTube in the description section. So the RS, a reverse split, sometimes you'll see it, abbreviated that way, but a reverse split, how does it work? Well, all it does is it does two things at once. It's a manipulation of the share structure. So the stock that or the shares that a company offers, it's going to manipulate all of that. And what it does is, so it'll take the number of stock or the number of shares out there, and it will decrease them. So the number of shares goes down, which causes the share price, because there are less shares out there, it causes share price to go up. So in other words, let's just say that a stock is dropping, and let's just say at this point it gets down to like $1. And the company says, this stock, we're getting way close, we're getting too close to zero. So what can they do? Well, they can go and they can do a reverse split, and they can then cause the share price to go up to, let's just say, $25. But by doing that, they are now making less shares available. Again, if you want all the math and how this works, go watch that other video. But you just need to know that the less shares there are available. So in other words, if you had somebody over here, using the logic that we're talking about, and let's just say, we'll call it, during this phase right here, let's say that they had 100 shares. But then after the reverse split happens, well, there are less shares available. Now, the shares are worth more, so it all equals out. But in this situation, well, they no longer have 100 shares. Again, I'm making this up, but let's say they now have 50 shares. Again, let me be very clear. If this person at that point in time had $1,000 in it, it's still $1,000. The point here being is that they just have less shares because it's all got to counterbalance out. But let's just say that this company, for whatever reason, price starts to drop. It gets back down to $1. Well, the company's saying, well, we don't like this. We don't want our stock at $1. It makes it harder for a bunch of things, right? A company wants its stock price, generally speaking, as high as possible. So we're going to, we don't want our stock price at $1 anymore. I mean, that's no good. So let's go ahead and, let's do this. Let's get it back up to, let's just say $25 once again. Now, what does that do to this person? So a little miniature quiz question. What is that going to do to the 50 shares? And if you're saying, do I understand reverse splits or not? From a general sense, you understand reverse splits if you're saying, well, because they did another move to the upside, they did, in other words, another reverse split, well, that person no longer has 50 shares. Now their shares are maybe down to 25, right? Because that's how a reverse split works. Your ownership, the number of shares you own, goes down. So now let's say that, for whatever reason, stock starts to drift again, gets down to $1. And you know the story now. The company does not like that. They don't want their share price to be at that level. So they're going to, let's get it back up to $25. So coming back over here, what's going to happen to that share size? Well, you're saying, okay, Glenn, now I definitely know. A reverse split causes shareholders, investors, it causes their investment in terms of the amount of shares they have to go down. So now let's just say they're at 10 shares. Now think about it. We started with the person still having, $1,000 after that first reverse split. You have less shares, but they're worth more. But when they keep dropping and then raising it back up, let's do the math now. If they now own 10 shares and each share is worth $25, how much does this person now have money-wise in the trade? Well, they have $250 left. Now, again, the share price is back up to $25, but they only have $250 left, which they started off at $1,000. Once again, how is this possible? Because the number of shares you own due to reverse split goes down and down and down. And eventually, I'm not going to keep, if I'm doing my job right, you understand the pattern here, but eventually, if this keeps going down and they keep doing another reverse split, goes down, goes up, the amount of shares you own is going to be fractions of a share. So in other words, it's going to eventually disappear. Now, am I saying that this is, a possibility? Well, yeah, I am saying it's a possibility. So just because, and the kicker, I'm getting a little bit ahead of myself, but the kicker about all this is think about it. During all of this, what has gone on? The company's still there. The company has not gone bankrupt. In fact, in many situations, the reason why it's not going bankrupt is because a reverse split is kind of like a sacrificial ceremony. Who is being sacrificed? The shareholders. The shareholders are being sacrificed by, hey, you know what? We're gonna take some of your shares, and they're just poof, gone. And you do this enough times, and the shareholders are literally wiped out. Now, of course, depending on when you get in is going to depend that. But my core point here is, hey, this stock's going to be around. This company's going to be around. Well, yeah, the company's still around. It's still around. It's still around. But yet you, the investor, the shareholder, your shares are going down and down and down, in not in price, but in how many you own. And then eventually you're going to find yourself sitting there owning a third of a share, a half of a share, a quarter of a share, an eighth of a share. And so that is where you got to understand that just because something is going down and going down, well, yeah, but I mean, this company's, they're not going to actually go bankrupt. They're not going to actually go anywhere. And my point is this: they don't have to go bankrupt. They don't have to go anywhere in order for your investment to literally disappear or go to pennies on the dollar. That's not a requirement. So be aware of that. If you want to learn more about reverse splits, keep that in mind. And let me just say this one instance: I'm not saying that this is what AMC is going to do. They just happen to be the stock that popped up in these comments that I'm talking about. So this is not directed at AMC. I'm just directing it as the overall logic that's being deployed of a stock is going to be around because the company's not going to go bankrupt. Therefore, I'm fine. That's not true at all for what I've just discussed here due to reverse splits. So if you have any sort of additional questions on it, please let me know. I would say if you want to learn more about the reverse splits, just go watch that other video first. But even if you have to watch that one and then you still have questions, then by all means, feel free to ask those down below. But hopefully this video helps. And I wanted to get it out there because, like I said, I'm not saying any of this in a judgmental way. I've been there. I've used this logic. But if I had done my job now, right, in explaining it, hopefully you can see now why it's bad logic. And you want to be picking stocks. You want to be buying stocks on companies where they don't have a history of reverse splits. So if they've gone through pullbacks, you're like, well, have they ever reverse split? No. You want forward splits, but that's a topic for another day. But if a company has a big history of reverse splits, you might want to rethink things for the reasons discussed here. First off, thanks so much for watching the entire video. Real quick, before you go, I want to invite you to a live webinar, web class, training, workshop, online event, whatever you want to call it, but it will be me live revealing to you what I've discovered that has allowed me to transform myself from being an employee to being my own boss, including how I had only one losing day out of 73 days in total. I'm going to cover 3 keys that have helped me unlock profitable consistency within the markets. The first key is super weird, but in a productive type of way. The second key is super awesome because it quite literally is wired into our DNA as humans, making it very easy to use. But in a cruel way, this becomes a pitfall for many traders. I'll explain it all though, including how to avoid the pitfall that it creates for some. And yeah, the third key, when you hear it, sounds way too good to be true, but it's not, and I'll show you how it all works. Then at the end, I open it up for a question and answer session that is, again, totally live. Even if you can't make the live session, please still sign up as it will be recorded, and you can go back and watch the replay that I will send you. Click the image on the screen or click the link down in the description box so you can get the date and time and claim your spot, which I should note is limited due to the fact that this truly is a live event. If you have any questions, let me know. If not, I'll be seeing you soon.